Okay guys, welcome back. Sorry about the mix-up with the test last week. Internet of any kind for my Tuesday guys, which means I wanted you guys to all rate the same situation, so that's why I had to do it at home. However, in 2 weeks, we have midterm 2, which is chapter 2, 3, and 4. It's November 3rd, and it's going to be in the lab as long as everything goes okay with their servers. And again, I'll be putting out information about. So, this question was at the end of your notes. So if you printed off the notes, it's right there at the end. It's problem 311. And I wanted to do it because we move into consolidations where we buy shares of another company in chapters 4 to 9. And people tend to forget about what happens if we actually buy the net assets. So this one's showing us the net assets, and then at the end, consolidated if we bought the shares instead of the net assets. Okay? So let's read through this, see what little pieces we need to take forward. Now it's pretty small, you guys, so sorry about that. Okay, so Myers Company formed 10 years ago, issued 34,000 common shares. 4 years later went public and issued 30,000 shares. Management in which Myers is going to purchase all of the assets and assume the liabilities of Norris. 2 proposals. So, Myers was offered to pay assets, and they'd have legal appraisal and finder's fee for a total cost of $6,200. Or they're going to issue shares currently valued at $720. Other costs would be cost of issuing the shares. So they're going to give them, instead of cash, they're going to give them their own shares because they're worth something. So just from that point, how do we know we are not going to do a consolidation? Because we bought net assets. So it's just like buying equipment. You're getting something, putting it on your own balance sheet. Consolidation. So this one is going to be no consolidation because we bought net assets. They go on our balance sheet. So if you've had a chance to listen to the videos, you know you can do 2 things. You can either buy net assets or you can buy their shares. In this chapter, we buy 100%. As we move on, we'll buy less than that. And we can pay 2 ways. How can we pay? With cash or shares. Right, so you had that little diagram. Make sure when you're reading a question, you know which way you're going. Okay? So we're going to pay cash for the net assets, and there's a fee. Don't put the fee in the cost of acquisition. Instead, expense it, or them. Okay, that's proposal 1. Let's just look at proposal 2 for a second. Issued shares, currently trading. Again, legal appraisal and finder's fees, we're going to expense. But we do something weird. What do we debit? But common shares themselves. Excellent. Okay, so then it tells you a little bit. Be offered 5 seats on the 10-member board, and they'll be absorbed in the surviving company, and so on. Then it gives the balance sheets prior to the, here's Myers, here's North. What we know is when we buy assets or assume liabilities, and this is way back from probably 311, we put it at fair value, right? So when we buy Norris's net assets, we have to use the fair value, okay? So I'm just going to put some totals. So total of all of these, 64885, and total here is 220115. Sorry, I don't know why it's doing that. Okay, so required for each of the proposals and then the balance sheet. So, anything else I want to tell you here? Oh yes, one other thing I want to do before we jump to the next little page is right here. We're going to issue 62,000 shares. Now, when you went through the notes, if we issue shares, so we're giving that company across the bar shares. Well, what? Pardon me? Yeah, they've got all the power, right? So that's called a reverse takeover. And you do it for different reasons. On an exam, I wouldn't combine it with the question like this, where you have to calculate it, because if you got it wrong, you'd do things backwards, right? So, with this, we have to check who has control of Myers. Okay, so just for reading the question, those are all the key points we have to look for and what we have to think about. Anyone still need this? Okay, let's go to proposal 1 then. Now, do companies always pay exactly the fair value of the asset that they're buying? No, often more. What's that called?
Goodwill.
Goodwill, okay? So, starting from here and pretty much all the way to the end of the book, we are going to calculate goodwill first before we do anything else, because goodwill has to be calculated first, okay? So let's do proposal 1. Okay, so a lot of times the questions aren't going to tell you. You just have to know, oh yeah, I've got to do goodwill first. Okay, now, because we're net assets, we can use the short goodwill calculation. And actually, you guys, in this chapter, you can pretty much always use it. It becomes more important to separate it out when we're not buying 100% and when we're moving forward in time, which we won't do till I think chapter 5. Okay, so what do I calculating goodwill? Yeah, consideration given up. Perfect. Now, in this case, you just paid cash. So you could have put cash paid. Consideration given up is a general thing because maybe we've got a receivable that's in there. Maybe we've got, I can't remember the word. Extra incentives, like if their net income goes up in the future, we will give them extra money to the shareholders or something like that, okay? So consideration given up. How much did we give up? Well, this one's easy because it's just the price paid. So $446, $400, and remember, no expense, no legal expenses. So don't try and combine them. To do it nice and short, we're going to take off. We want to know the difference between what we paid and what we got in fair value. Anything extra is goodwill. So we're going to take away fair value of net assets. So looking back here, we already calculated it just to make it easy so we don't have to write it all out. We've got minus 220,115. So assets minus liabilities and that should equal 344,770. So we paid $446,400. The actual fair value of everything we bought was $344,770. So the excess is $101,330, sorry. And that's goodwill. So why would we pay extra? That seems kind of dumb. The assets are only worth $344. We're basically taking over the business, right? So having anything that comes with it could increase our business more than just the value of the assets, right? Because as we know, everything isn't on the balance sheet, okay? Like maybe we've got some of their employees that came to us and they're highly trained, that kind of. Okay, so the next thing they wanted, well, you have to do that first. Do the journal entries for Meyer for proposal 1. So even if you haven't done the videos or read anything, just go everything off Norris's balance sheet, recording it at fair value because that's the rule for when you buy assets. So give it a shot. Try piecing that together. Leave some room for debits, credits, and fill them in. And just let me know if you have any questions. Do you guys need the problem back, or are you good? Okay, let's try piecing this together, you guys. Okay, you can do it in any order. What are we giving away? Cash. Right, so if you're stuck, you can do that. Focus on cash. Now, we're giving that up. What are we getting? Look at their balance sheet and go right down the list except put it to fair value. So what are we getting? Cash. Now, could we net those two cashes out? Yeah, I find though sometimes it helps not to, because it's easier to see what's happening. Something's going, we're getting some stuff. Okay, we're also getting AR. So I put AR at 73,450, right? It has to be fair value, so 68,200. And these are fair value. Okay, inventory. 146,220. Land. And notice these are net. Well, no, forget that. Land doesn't have depreciation. The next two are net. Buildings are net. 36,020. Equipment, 27,945. Okay, we got the assets. What else did we have to take over or assume responsibility for? Net assets, right? Or net assets, liabilities, right? So we have current liabilities, for 53115, and non-current liabilities for 167. Okay, we're done, right? No, it doesn't balance. What's missing? Goodwill. Excellent. At 101,630. So don't forget, that one's really easy to forget. Now, did Myers have to do anything else? Yeah, they paid for so that one's kind of easy. Debit professional fee expense or something like that, closest you can find, and credit cash. Okay. Whose books were these entries done in? Myers. Are they actually in their actual books? Yeah, because they're actually acquiring the stuff. They own the assets now, just like buying a photocopier. Okay? So just a little reminder. These are all in Myers' books. Okay, so if this was a consolidation, what on here would actually be done in the books? So if we weren't buying all the assets, like buying a photocopier, buying their equipment, buying their land, and it doesn't have to come to our business, but it can be somewhere else, but we own. What if instead we bought all their shares? So they were over there still running their little business, but we owned all the shares. Would we be moving this over to our books? No. Okay? So, if we bought shares instead, the only entry would be credit to cash for 446. 400. I didn't leave myself enough room. Okay. We would also do this for buying shares. So what would we do with all this other stuff? That would go, remember we said there's a consolidation worksheet that we do. Or if it helps you to separate it in your head, because it's very critical. Myers' books are back here, okay? Norris's books are back there. But if we bought their shares, somewhere in the middle, Myers as the acquirer is going to be working on a little consolidation worksheet. So I just call it the consolidation laptop, okay? To keep it in the books of Myers. Okay. These other entries, other accounts would be entered on consolidate. I'm just going to call it laptop, okay? So you can physically see something different that the books aren't on. Okay, in reality, of course, it's the same computer. You guys are just going to tell. Okay? That's the contrast between buying assets versus buying their shares. Their shares, we still control them, but we don't own their assets. We own their shares. Okay? So that's a big difference. Everybody okay with that? Excellent. Want us to do is do the balance sheet for Myers. So I think I'm going to use a new sheet. So basically the balance sheet is going to be Meyer stuff plus the entry we made putting all this on, right? Plus the goodwill. Okay. So why don't you guys start doing that. I'll give you a few minutes just to go through and try and work through some of it. Cash is because there's usually extra transactions. And let me know if you have a question, guys. So let's just look at the cash, you guys, because that one's got the most things happening. So what did we start with? What did Myers start with? $552,000, right? These are actually in Myers books, little T accounts, little software program. We added cash here. We subtracted cash here. And then we subtracted cash here. So you've got to make sure you hit this one, and that one. So we're going to add the 64.5 minus what we, and minus the 6,200, which gives us 163,900. Oh, sorry, you guys. It was kind of a waste, wasn't it? You're welcome. Thanks for letting me know. So this is essentially the same as consolidation, except if we consolidation, because we just bought the shares, we wouldn't have the 64.5 and the 44.6 on Myers books. It would be in the consolidation worksheet with a laptop. Questions with that cash? AR is pretty straightforward. We started with 179,200. And then we have two choices because Norris has 73.50 and 68,200. Which do we use? $68,200. Always use the fair value. Works out to $247,400. And then inventory, land, buildings, they're all the same as AR.